Welcome to Worldwise Studio, where the world's biggest ideas become surprisingly simple.
Open up pretty much any financial newsfeed right now, and you are bound to see the exact same sensationalized headlines. We're talking stuff like the imminent collapse of the US dollar, the end of American financial supremacy, the rise of a whole new global currency order. Look, I get it. It sounds absolutely terrifying, right? But as someone who genuinely loves getting past all that noise and looking strictly at the hard data, I want to welcome you to this explainer. Today, we're completely stripping away the hype and the fear-mongering. We're going to look at exactly what is actually happening to the world's reserve currency. Because, right at the heart of all those crazy headlines is one central question. Is the world actually dumping the US dollar? And to be fair, we're seeing some major geopolitical shifts that make this question incredibly relevant right now. For instance, Saudi Arabia recently opened a door to accepting yuan for its oil. That breaks a decades-old tradition. Meanwhile, Russia is now trading almost entirely outside the dollar system, and dozens of other nations are signing agreements to just bypass the greenback completely. Now, what's really interesting about this slide is that the premise of those scary headlines isn't entirely wrong. The data actually validates that a huge shift is underway. Just think about this. Back in the year 2000, the US dollar made up over 70% of the world's currency reserves. But today, it's fallen to around 57%. That is a precipitous drop. In the macroeconomic world, falling that fast is a really big deal. But hey, you might be wondering, why should you care about this if you've literally never traded foreign exchange in your life? Well, it all comes down to a concept economists call exorbitant privilege. Because the rest of the world holds dollars, foreign governments and investors are constantly buying trillions in US Treasury bonds. That endless demand is exactly what allows the United States to borrow money incredibly cheaply. And guess what? That trickles right down to your wallet. It's the exact mechanism that keeps your mortgage, your car loan, and your credit card rates significantly lower than they would normally be. And that right there brings us to the actual stakes of this entire situation. The United States is currently sitting on a national debt of roughly $37 trillion. $37 trillion! If the world decides it suddenly needs fewer dollars, that exorbitant borrowing privilege, it starts to shrink. And if that happens, the cost to borrow that $37 trillion absolutely skyrockets. Import prices rise, inflation ticks up. So you see, the stakes of the world walking away from the dollar aren't just some abstract Wall Street problem. It represents a fundamental shift in the daily cost of living for the average consumer. So how did we actually get to this point? Okay, let's dive into this. Part 1, how we got here, the dollar's rise. To really understand the current threat, we have to look at how the dollar achieved its absolute dominance in the first place. The story basically revolves around 3 massive pivot points. First up, it starts in July 1944, at a hotel in Bretton Woods, New Hampshire. The US held most of the world's gold at the time, so a deal was struck. Global currencies would peg to the dollar and the dollar to gold. Fast forward a bit to 1971, and President Nixon cuts that link to gold. But instead of everything collapsing, the US struck an understanding with Saudi Arabia to price oil in dollars. Boom, the petrodollar era was born. Everyone needed energy, so everyone needed dollars. But the third pivot point, that's the most crucial one for our current moment. 2022, when the West froze roughly $300 billion of Russia's central bank reserves following the invasion of Ukraine. That 2022 freeze was an absolute shockwave to the global system. Literally overnight, every government on Earth learned a profound lesson. Your dollar reserves, basically your nation's savings, can essentially be switched off if you cross Washington. That event was the specific catalyst that moved de-dollarization from being just a fringe economic theory into official, active policy in capitals all over the world, from Beijing to Brasilia. Which brings us to Section 2, the scales, forces versus walls. To really figure out if de-dollarization is actually working, we have to weigh the scales. Here are the 3 main active forces eroding the dollar right now. Force number 1, sanctions fear. As we just saw, the freezing of reserves has central banks totally spooked, pushing them to quietly diversify. Force number 2, bilateral currency deals. China is settling way more trade in yuan. India is buying oil in non-dollar currencies, and Brazil and China are trading directly with each other. Each deal on its own is pretty small, but together, they slowly chip away at dollar demand. And finally, force number 3, America's own finances. Trillion-dollar interest payments and constant, bitter political fights over the debt ceiling are creating some very real global unease. There's a saying going around, every crisis makes foreign holders ask, is the dollar as safe as it used to be? And that quote really nails the psychological shift happening right now among global central banks. Every single time there is a geopolitical crisis or another messy domestic debt ceiling fight in the US, foreign holders ask themselves if the dollar is still the safe haven it once was. And they are answering that question by buying up gold at a truly historic pace. Actually, gold has recently rivaled US Treasuries as a share of official reserves. That's a massive shift. And this brilliantly illustrates our next point in Section 3, the three walls defending the dollar. See, while those doom and gloom headlines are super loud, they completely ignore a much-needed grounded reality check. And that's the massive structural walls currently protecting the dollar. Wall number one is China's own capital controls. Think about it. A reserve currency has to be instantly sellable at any time, but you cannot freely move money in and out of China, meaning the yuan simply cannot function as a global reserve yet. Wall number two is trust in the law. Investors hold dollars because U.S. courts, for all their complexities, heavily protect property rights. Most nations just won't park their national savings in a country that can change financial rules overnight. And then there's wall number three, global liquidity. There's simply no other market on the entire planet deep enough to absorb the massive scale of the world's savings, period. When you translate those defenses into hard data, the contrast is incredibly stark. Just take a look at this breakdown of global reserves today. The US dollar still sits pretty at 57.1%. The euro is a very distant second at 20%. And the Chinese yuan? Well, despite years of intense geopolitical effort and all those bilateral trade deals we talked about, it sits at roughly 2%. That 2% figure, that's the ultimate reality check here. Yes, the dollar's share is absolutely eroding, falling from over 70% down to 57% in a quarter century. But it is not being entirely replaced by one giant rival like the yuan. Instead, it's leaking slowly into gold, into smaller currencies, and into regional deals. So this isn't some sudden catastrophic collapse. It's a very slow-motion diversification. And if you want even further proof of that global liquidity wall we just talked about, just look at global foreign exchange transactions. Nearly 90% of all foreign exchange transactions on the planet still involve the US dollar on one side. 90%. Over half of all global export invoicing is done in dollars. Not the euro, not the yen, and certainly not the yuan can even come close to handling this sheer volume of cash. So let's move on to Section 4, winners and the global fallout. So who actually benefits from this shift and who ends up suffering? Let's break it down. On the winner side, you've got gold and obviously the countries that mine it. They are absolutely thriving right now as central banks just keep buying. Then you have commodity exporters like Brazil and the Gulf states, who are gaining huge bargaining power by pricing their stuff in multiple currencies. And interestingly enough, U.S. exporters also win here, because a slightly cheaper dollar makes American goods way more competitive abroad. But on the loser side, well, the U.S. government's ability to use sanctions weakens as alternative payment rails start to grow. American consumers lose some of their cheap import lifestyle, and foreign nations holding massive dollar reserves have to sit there and watch their savings slowly lose value. So the crucial point is a really deep irony in all of this. If borrowing costs start to climb because fewer countries are buying U.S. debt, the biggest loser of all will actually be the U.S. government itself. They'll be forced to pay more and more interest on that massive $37 trillion mountain of debt. Ultimately, the greatest threat to the dollar simply isn't an external rival like China. The math shows it's Washington's very own balance sheet. Let's move to and see how this builds into our final part. Section 5, future scenarios. Where do we go from here? Knowing all this data, where does the global economy actually go? Well, there are basically three highly probable paths forward. Scenario 1 is what we call slow erosion. The dollar drifts from 57% down toward 50% over the next decade. It remains dominant, but it becomes less able to fund unlimited U.S. deficits. Scenario 2 is currency blocks. The world actively fractures into regions, like a dollar zone, a yuan zone in Asia, and a euro zone. Global trade gets highly complicated, and gold acts as the neutral referee between them all. And finally, Scenario 3. The dollar holds. The U.S. miraculously gets its debt under control, no rival manages to fix its own internal flaws, and decades from now, the dollar remains entirely undisputed as king. Look, the honest reality is, nobody can tell you with absolute certainty which of these scenarios will perfectly play out. Frankly, anyone who claims they know for sure is probably trying to sell you something. But the good news? You now have the actual tools to watch the truth unfold for yourself. Don't fall for the sensational headlines. Watch the central bank reserve data. Watch what central banks actually buy with their money. So, I want to turn it over to you. Looking at the slow erosion of the reserves, balancing that against the massive walls defending the dollar, and then factoring in that rising U.S. debt. Scenario 1, 2, or 3. Which future do you think will become our reality? Drop your pick and your reasoning down in the comments and keep a close eye on the data. Thanks so much for joining me on this explainer, and as always, keep learning.